Hello everybody, this is Toni Turner and welcome to the market now as of about 10:30 a.m. Eastern on Friday, January 29th. Wall Street is higher so far today after weak GDP data raised expectations that the U.S. Federal Reserve just might slow action on future interest rate hikes. U.S. gross domestic product rose 0.7% in the fourth quarter, below the 0.8% expected. Also reported today, the Bank of Japan cut a key interest rate below zero in hopes of lifting its flagging economy. As you probably know, the market is still reeling from one of the worst starts to any year as oil prices remain under pressure and fears of a China-led global slowdown continue to grow. U.S. stocks cannot seem to keep a rally going so far this year, and we've not seen gains for 3 days in a row so far. The S&P 500 has shed 7.4% this year to Thursday's close. That would be yesterday's close. Now let's look at three charts that could give us some insight into the week to come. First of all, as we usually do, we're going to look at our daily chart of the S&P 500 Spider, symbol SPY. This is the exchange-traded fund that closely correlates to our S&P 500 index. Now, I know we just said that the market was down 7% since the open in January. However, if we take it from the December high back here, the December 29th high of $207.79, the SPY has actually fallen. And we take into consideration last Wednesday's low, we can see that from that high down to this low, the SPY has fallen about 13%. So we've actually got a lot going on here. We know the SPY is trading below its 20-day moving average, the red line, its 50-day moving average, the green line, and the 200-day moving average. These are all simple moving averages on this chart. We can see now, again, we know that for all intents and purposes, last Wednesday's low held certainly held the prior October low, or let's see, that might have been the end of September, and the August low. So we're good with that. This support down here is 181. We also said last week, as we put Fibonacci lines on this chart, stretching them from this high that I mentioned in the last week of December down to this low, we said our 38.2, I believe that was the level retracement, was going to take it up to 191 as resistance. We also see coming down overhead the 20-day moving average right to the point where the SPY is right now, where I captured it at $191.50. So this is an important level right here. It's going to be crucial next week to see, as we continue through earnings season, if the SPY can hold this level here of 191 and change and break up through it. That would be great. We know the Fed isn't going to, or hasn't raised interest rates. Now, of course, we're looking forward to March to see what we'll do there. If the turbulence in the markets and the world continues, it's probably possible that they may not, but of course that's speculation. Otherwise, we have these lows down here at 185 and 181 to keep an eye on. Why do we watch the SPY or the S&P 500 index so closely? It's because in bull markets, 3 out of 5 stocks will follow the S&P higher. 4 out of 5 stocks in a bear market will follow it lower. So we certainly use this as our leading indicator, the S&P 500, for which way the market and indeed most of our stocks will travel. So again, we've got a zone going here, lows, support lows at 185 and 181, resistance at 191. If it can break higher here, that will be fantastic next week, but the jury's still out on that. Our next chart is a chart that we looked at last week, the Select Sector Spider Energy ETF, symbol XLE. I know all eyes are on oil, and for good reason. It's a place where we can look to make profits. The top components in this equity ETF, again, are Exxon, Chevron, Schlumberger, Halliburton, National Oil Well, Varco, all of the big energy companies. Now, we had a January 20th low down here of 49.93. Today, as I captured this chart, the XLE is trading at $57.17. So that's quite a move up. That's over a 10% move up. I could see here with this pattern, we only have a single pivot low here. Now, it is possible for the XLE to move up without moving back and retesting these lows. It's possible. It is above the 20-day moving average, but that 20-day moving average is still moving lower. It is still below the 50-day moving average, which is still moving lower. We do have the RSI moving up here in conjunction, the 14-day RSI, with price. However, if we just look at price and price alone, it appeals to me. I think that we probably will have maybe a slight, but I think we will probably have a slight retracement here, perhaps back down to the 55 level or the 53 level where there is support. That seems more likely to me than not. So I know a lot of you are anxious to get into energy stocks, so am I. However, I have found over the last 20 years in investing in trading that patience is quite a virtue and actually can make you money. If you really want to get in here, if you really believe these are the lows in oil, which of course directs this ETF, maybe you want to scale in. Maybe you just want to buy, instead of 500 shares, maybe you want to buy 200 shares or 300 shares. Again, I could see a pullback coming here, maybe not a big one, perhaps not all the way back down to 50, but some portion of the last move up, I could see the XLE moving back down into this area a little bit. So if you do want to get in now or even wait for a little pullback, also as you may scale in, you may want to use smaller share size, and you'll definitely want to place hard stops with your broker. We will continue to monitor the XLE as the weeks go forward. Our final chart for the day is the Select Sector Spider Staples ETF. As you can see, it is a lot happier looking, certainly than the S&P 500 or the SPY, certainly than the XLE. Staples are where we go when we want to kind of wait out a storm. It's certainly one place we can go. Again, symbol XLP. This is an equities ETF as well. The top components, it has 40 holdings in it. The top components are Procter & Gamble, Coca-Cola, Philip Morris, CVS, the drugstore, Altria, Walmart, Costco, those kinds of stocks. You may be interested in knowing that if you hold it for the longer term, as of right now, the XLP does pay a 2.59% annual dividend. Now we can see that the XLP came down to a November low of about $47.57. We can see in the move down that it made with the S&P 500 at the opening of the year, it didn't fall as far as the S&P 500 percentage-wise, certainly, and it rallied off of those November lows. It held those November lows. That is quite a good feat, and it did so right through the first week or two of earnings season. As I captured this chart, the XLP is trading at $50.15 above its 20-day moving average. Now it's very slightly rising. That's good news. 50-day moving average, and certainly above its 200-day moving average down here, coming in now at about 49. The RSI is softly trending higher here. That's a good thing. The MACD line, the black line itself, is trading above the red signal line. That's good, although it is not yet above the midline, the zero midline. If the XLP continues higher, that should happen within the next couple of days. Now, if you're a trader and you want to fine-tune your entry and you think it's something you might be interested in to kind of go hang out in staples for the next week or two and see what's going on, I myself here, as being a trader, will probably wait for a slight pullback. It's up to you, but I suspect purchasing a small amount of the XLP, and I'm going to keep small on all my positions right now, somewhere between $49 and $50.25, somewhere in this range here. That may be some attractive to traders out there, again, who kind of want to go hang out where it's a little more mild-mannered, not quite as much turmoil in the market. Okay, now we'll go on to next week's economic reports. But first, please join us this coming Monday online from 4:30 to 6 p.m. Eastern for our next session of Toni's Market Club. We'll talk about which side of the market to trade, have a mini trading lesson, and I'll give you stocks and ETFs that may become ripe for high potential trades. This is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. So please join us. For those who cannot attend our live session, not a problem. The recording of our session is available to all of our members a few minutes after the session ends. And now the coming week's economic reports. On Monday we have PCE prices and the ISM index. That's the Institute of Supply Management monthly report that's very important to the market. Tuesday, we have auto and truck sales. Wednesday, we have the ADP employment change, ISM services, and crude inventories. Of course, that's weekly. Thursday, we have our weekly jobless claims and pending home sales. Friday, we have a monthly jobs numbers with the unemployment rate. That will probably be the most watched economics report of the week. Please also remember we are still waiting through earnings season, and those earnings can certainly move the stocks that move the market. The large caps will have the power to pull the major indexes up and down, and you've seen that already in the last 2 weeks. So again, join us for Toni's Market Club this coming Monday. Don't miss out on this fantastic opportunity to raise your trading knowledge and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.